Okay, Home Depot, AT&T down 7+% on the news that came out that we're going to analyze through and see what is going on with these dividend kings. So let's jump right into this. Welcome back, my passive income investors, to this exciting news taking AT&T Telecommunications down a whopping 7%. Home Depot down another whopping 7% as well, which makes these extremely attractive companies to dividend investors like myself. If you've never heard of these companies, well, they are dividend kings paying out massive yields for the last decade. I mean, take a look at Home Depot, guys. If you bought this back in 2014, only 5 years ago, your 47-cent quarterly dividend has grown all the way to $1.36, which means if you were getting a 2% annual yield today, it is almost up to 6%. So before we get into the news, a quick reminder, guys, we just recently launched Passive Income for Dummies. If you want to learn about stock market investing, get special custom tracking tools, and join our personal private membership where we chat stocks, feel free to come on over here, guys. Really exciting stuff. So let's get right into the news, starting with Home Depot. Home Depot is a company I pay massive attention to because it really resembles what is going on in this housing boom. And if we have another crisis in the markets where housing starts to slow down, well, you're going to start seeing these numbers show up in Home Depot, and this might be a sign of a pending recession. So let's read the news, shall we? Home Depot slides after cutting its full year profit outlook for the second time. So if we read through here, Home Depot reported third quarter 2019 earnings Tuesday that missed analyst expectations, and the shares fell as much as 7.5%. But let's read what we missed on. So earnings per share, $2.53 reported versus $2.53 expected. So it looks like we hit earnings per share, but where things kind of got a little bit buggy was in revenue. They had $27.22 billion reported versus $27.72 billion expected, and same store sales were reported at 3.6% versus 4.6% expected. The company also cut its full year outlook for the rest of 2019, saying that some of the business investments, including updates to its online shopping experience, haven't yet benefited sales. Home Depot now expects full year comparable sales to grow about 3.5%, where it previously had forecasted about 4%. The company also trimmed its revenue outlook to growth of 1.8 from 2.3. So if you don't know what Home Depot's done, essentially, Home Depot released an online section of their store where you could order what you needed online, and then it would be put into a little shipping box thing or a little kind of like a locker that you could come and pick it up at the store itself. And the thing with Home Depot, though, is most people like to feel the products. They like to see what they're buying. So it's very driven through online, or not online, but in-store sales. So that's why we can see that Home Depot is one of those companies where Amazon might have some problems picking up any kind of real market share. But Home Depot and Lowe's both have taken big hits. They're both the big outlooked companies when it comes to the housing market. So let's take a quick peek at AT&T and see what's going on with this company. So what happened? Shares of AT&T fell 5% on Tuesday after influential research analyst Craig Moffett downgraded the stock to a sell. So what? AT&T is a company in transition, having paid $67 billion to acquire DirecTV in 2015 and $85 billion to buy Time Warner last year in an attempt to transform itself into an entertainment giant. The acquisitions have piled debt into the balance sheet and attracted the scrutiny of activists. So essentially, if you're involved in this company, I don't own it personally and I haven't been aware of this, but it turns out that they have been heavily trying to get involved with the same stuff that like Netflix and Disney are doing, but apparently it isn't working out nearly as well as they hoped. Let's continue to read. The company responded to investors' concerns last month by laying out a 3-year plan that called for no additional major acquisitions. So they're really cutting back on spending. A review of assets and a reduction in debt. Obviously, AT&T expects to grow revenue 1% to 2% annually through 2022, delivering adjusted earnings between $4.50 and $4.80. It is expected free cash flow to come in between $30 billion and $32 billion in that year. So, I mean, their outlooks have been somewhat decreased, but for a company at this scale, it really at this point comes down to, can management keep up and actually perform to actually beat these expectations and continue to push the stock higher? But this is purely a dividend play. Most people aren't buying this for equity growth. If we take a look at something like an AT&T, I mean, over the last 5 years, you've had virtually no equity growth in this stock, but you've had a nice dividend that has slightly increased over time. I do not own AT&T because I like seeing more growth behind my companies, but I do own dividend stocks that don't really grow that much, and I'm just holding them for the yield. So if you're interested in high yield starting stocks, AT&T might be pretty attractive, especially if they can start pushing their earnings. If they can do anything to even slightly beat earnings expectations at this point, which they have done in the past, we could see this company head into higher. Let's just continue reading. Now what? Well, with the entertainment and business wireline groups likely to struggle to generate growth, there is a lot of pressure on AT&T's wireless business, which accounts for about 40% of total revenue. Due to heavy lifting, Moffett in his downgrade is betting it won't be able to deliver. AT&T shares currently trade at less than 8 times the midpoint of that 2022 earnings guidance. Rivals will pay the price for underestimating Disney. Yeah, a lot of people weren't expecting, I wasn't even expecting Disney to smash out 10 million users. So AT&T, the CEO, John Stankey, became the latest rival to offer a backhanded compliment to Disney Plus this week. Speaking at Redcode's Code Media Conference in California on Monday, he congratulated Disney on its initial success, only to wonder if the media giant can keep the momentum going. Well, it's really going to be neat to see how all of this plays out. Everyone and their grandmother seems to want to get into streaming. It seems to be the new head front for growth in anything to really do with entertainment. So we're going to see a lot of competition, a lot of stricter rules coming out from Netflix and things of that nature. But to not stray too far away from the discussions today, guys, AT&T, I would love to know what you think about it in the comments section below. And on top of that, guys, Home Depot is one that I have analyzed excessively with its incredible performance over the last 5 years. It's incredible dividend increases. If this thing took a major dip, it is one that has been on my buy list. I wish I was buying it on the first major dip that it took in 2018, but if this thing starts dropping back to the low 200s or even high 100s, I would consider severely adding this company to my portfolio. But again, it isn't the most recessionary proof stock, as we can see even back in 2008 when the market started taking a dive. This company fell a whopping 50% at the lows. So just fun stuff to pay attention to, guys. And on top of that, one more reminder, I would love to know what you think about the recent launch of our new website. I will be doing a full breakdown on this very shortly if you guys want to learn further about dividend stock investing. So stay cool, stay awesome, guys. I look forward to chatting to you real soon.